Hi, I'm Brooks Ackley with Horizons ETFs. Thank you very much for joining me today. Today I'd like to use the Horizon Seasonal Rotation ETF, ticker symbol HAC, its weekly commentary, as a basis for this market update. So let's jump right in and take a look at the market action last week. Here we can see the S&P 500 was down 0.4%. The Canadian stock market was positive at 0.2%. Now last week was an interesting week for the stock market. We had two different sources of influences affecting the overall stock market. On the negative side, we did see some earnings from some large bellwether companies such as Amazon and Facebook and others come out and with earnings that disappointed investors and pushed the overall stock market lower during the week. On the other hand, we did see the Federal Reserve on Wednesday, after they finished this meeting, Powell and his meeting with the press, discuss and support his ultra-dovish monetary policy, which helped to push the stock market higher as investors like what they heard. Overall, the stock market did end up slightly negative for the week. HAC last week did increase its gold bullion holdings. Gold bullion is in one of the strong seasonal periods at this time of the year, and in particular, the sweet spot to this seasonal trade is August and September, and as a result, HAC did slightly increase its gold bullion position. If we take a look at what's going on in the markets here, we can see the S&P 500 was down 0.4%. Now, last week we did see the yield on the 10-year Treasury note close lower for the week. It closed at 1.24%. And despite falling interest rates, we can see the consumer discretionary sector, communication services, and technology sectors all negative and underperforming. Now, typically these sectors benefit from falling rates, but we did see some weaker than expected earnings coming from some large companies in the sectors, pushing these sectors down overall. If we take a look at some of the cyclical sectors of the stock market here, we can see that, generally speaking, they did quite well. The industrial sector, though, was negative. Materials did very well. Energy was positive, and also financials as well. And if we look at the defensive sectors of the market last week, real estate, consumer staples, healthcare, and utilities were all positive last week. Now, the gains in those sectors weren't as strong as some of the cyclical sectors of the overall stock market. So what should investors be watching out for in the upcoming week, basically? Well, if we take a look at where the stock market is heading on a seasonal basis, this is not the best time of the year for the overall market. Right now, we're heading into the weakest two-month contiguous period for the S&P 500 since 1950, and that is August and September. Generally speaking, in this time period, in August and September, the cyclical sectors tend not to perform as well as the S&P 500. And also the defensive sectors of the market tend generally to be better than the S&P 500. And it should be noted as well that this period tends to be a positive period for U.S. government bonds, and also, as I mentioned before, gold as well. So as we head into this weaker two-month contiguous period for the stock market, this is a time for caution. Thank you very much.